Welcome to the 2023 September edition of our HR Focus, your trusted source for HR news. The content in this news update should not be considered legal advice. Before acting on any of the content, employers may need to seek the advice of an employment and labor attorney for additional guidance. The EEOC has released proposed regulations on the Pregnant Workers Fairness Act, which went into effect in June of 2023. On August 11th, the EEOC published proposed regulations to implement the PWFA. The PWFA requires employers with 15 or more employees to provide reasonable accommodations, absent undue hardship, to a qualified employee or applicant with a known limitation related to, affected by, or arising out of pregnancy, childbirth, or related medical conditions. The EEOC's proposed rule addresses each element of this requirement, and as required by the PWFA, the proposed rule also provides examples of reasonable accommodations. The public may submit comments on the proposed regulations until October 10th. After the comment period closes, the EEOC must implement final regulations by December 29th. On July 31st, the U.S. Department of Labor published its revised model notice for employers regarding the Children's Health Insurance Program, also known as CHIP. The CHIP notice is required to be distributed annually to all employees in states that provide premium assistance subsidies under a Medicaid plan or a CHIP plan. Employers with group health plans that cover participants in states that provide premium assistance subsidies are required to notify their employees, even if the employer's location or principal place of business is not in one of the states listed in the model notice. The notice may be provided with the summary plan description, enrollment packets, or open enrollment materials. Employers can choose to provide the entire model notice to employees, or may shorten the notice and provide state-specific information only for those states in which employees reside. The notice can also be provided by first-class mail or electronically. Employers should ensure that the notice is sent to all eligible employees, as employers that fail to send the required notice may be subject to penalties. On August 8th, the U.S. Department of Labor issued a final rule updating regulations under the Davis-Bacon Act, which applies to federal and federally assisted construction projects. Of note, in the new rule, the DOL recommended returning to a three-step process previously used to identify the most frequently used wage rate for each classification of workers in a locality. The amendments take effect on October 23rd and include but are not limited to restoration of the three-step verification process for determining a prevailing wage that had been used up until 1982, making it equivalent to the wage paid to at least 30% of workers rather than 50% of workers in a given trade in a locality. The addition of alternatives for defining the area for multi-county projects in highway construction, an explanation that wage determinations must be updated after contract awards under certain circumstances, authorization and periodic adjustments of certain out-of-date, non-collectively bargained prevailing wage rates and fringe benefit rates, and the establishment of anti-retaliation protections. On August 23rd, the IRS announced that the Affordable Care Act's affordability threshold will be 8.39%, reduced from 9.12% in 2023 for plan years beginning in the calendar year of 2024. Under the ACA's employer shared responsibility provision, large employers, who are those with an average of 50 full-time employees, including full-time equivalent employees during the prior year, must either offer most full-time employees and their children minimum essential, minimum value coverage that is affordable at the employee-only level of coverage, or make an employer shared responsibility payment to the IRS if at least one of their full-time employees purchases coverage on a health insurance marketplace and receives a premium tax credit because their employer did not offer qualifying coverage. Under the new threshold, to be affordable for the 2024 plan year, the employee's required contribution to the plan cannot be more than 8.39% of their income. Effective January 1st of 2024, the minimum weekly salary for overtime exempt executive, administrative, and professional employees in California increases from $1,240 per week to $1,280. It is adjusted for inflation to match the monthly salary equivalent of at least 2 times the inflation adjusted state minimum wage for 2024 for full-time employment. The minimum compensation rates for overtime exempt computer employees and physician and surgeons paid an hourly rate will also be adjusted for inflation. Effective October 1st, the California Fair Employment and Housing Act regulations that restrict employers' use or consideration of criminal history in making employment decisions are amended. The amendments broaden the definitions of applicant and employer and modify the requirements for an individualized post-offer assessment of whether an applicant's conviction history disqualifies them from a job, among other things. As a reminder, effective October 1st, Connecticut's Paid Sick and Safe Leave law is amended to add a mental health wellness day as a qualifying reason for paid sick leave and to extend paid sick leave coverage to eligible employees whose child is a victim of family violence or sexual assault under certain circumstances. Connecticut's mandatory paid sick and safe leave law was adopted in 2012 and allows covered employees to earn 1 hour of paid sick leave for every 40 hours worked, up to a maximum of 40 hours per year. However, the law only applies to employers with at least 50 employees and only covers service workers who are either paid on an hourly basis or are classified as non-exempt under the Federal Fair Labor Standards Act. Covered employees fall broadly in categories such as retail, healthcare, hospitality, custodial, and food service. To determine the employee count, all employees are counted, not just service workers. Effective January 1st of 2025, Illinois employers with 15 or more employees will be required to include a pay scale and benefits description in job postings, including those posted or published by third parties. The law will also cover remote roles, including some where the employee is physically located outside of Illinois. Specifically, positions that will be physically performed at least partially in Illinois must comply, as well as positions performed outside of Illinois in which the employee reports to an Illinois-based supervisor, office, or other worksite. Although smaller employers with fewer than 15 employees are not required to publicly post pay ranges, all employers must share the pay scale and benefits for a position with an applicant upon request and before any offer or discussion of compensation if that information has not been provided in a public or internal job posting. In addition, the law requires employers to announce, post, or otherwise notify current employees of all opportunities for promotion within 14 calendar days of making an external job posting for the position. The law also contains anti-retaliation protections, whereby employers may not refuse to interview, hire, promote, or employ, or otherwise discriminate against an applicant or employee for exercising their rights to pay transparency. Violations of the law will be punishable by fines up to $500 for the first offense, $2,500 for the second offense, and $10,000 for a third or subsequent offense. For a first or second offense, employers will have a cure period to remedy the violation of 14 days and 7 days, respectively. The Maine Retirement Savings Program, which was signed into law on June 23rd of 2021, requires covered employers that do not offer a specified tax favored retirement plan, such as a 401k or 403b, to automatically enroll eligible employees in a state-run Roth individual retirement account plan. Eligible employees are permitted to opt out of the program. Once enrolled, employers must withhold by payroll deduction contributions for the plan and remit participating employees' contributions into the Maine Retirement Savings Program fund. Covered employers are required to start offering the program to eligible employees by no later than the following deadlines. Covered employers with 15 to 24 eligible employees by October 1st of this year, and covered employers with 5 to 14 eligible employees by April 1st of 2024. Covered employers with 25 or more eligible employees were required to begin offering the program as of April 1st, 2023. Among other things, the law also specifies the initial default withholding rate, the time within which contributions must be remitted, and employer noncompliance penalties. The program's 9-member board is expected to adopt implementing rules, which will provide further details on the program. Effective October 1st, Maryland employers are prohibited from including a non-compete provision in an employment contract with an employee who earns equal to or less than 150% of the state minimum wage. As of January 1st, 2023, the minimum wage in Maryland ranges from $12.80 to $13.25 per hour based on employer size, and will adjust to $15 per hour for all employers on January 1st of 2024, regardless of size. As a reminder, effective September 17th, employers with 4 or more employees are required to include a pay range and job description if one exists in any advertisement for a job, promotion, or transfer that will physically be performed at least partly in New York, or report to a supervisor, office, or other work site in New York. More information on this is available on the HR Works website. Effective August 23rd, the New York Human Rights Law protections for interns have been expanded to protect them from discrimination and harassment based on their gender identity or expression. Under the New York Human Rights Law, which has not been updated online just yet, interns are defined as workers who perform work for an employer for training purposes that are not required to be hired when they're done with the training and are unpaid. Effective September 1st, the Texas Regulatory Consistency Act prohibits municipalities and counties from adopting new ordinances or enforcing existing ordinances involving business, commerce, finance, labor, and several other fields of regulation. The act will nullify any rule or ordinance regulating employment leave, hiring practices, breaks, employment benefits, scheduling practices, and any other terms of employment that exceed or conflict with federal or state law. This is a critical development for employers, as this law will most likely nullify or preempt several local ordinances, including the enjoined paid sick leave ordinances in Austin, San Antonio, and Dallas, the predicting scheduling ordinance in Euless, the mandatory water break ordinances in Dallas and Houston, and the ban the box ordinances in Austin, among others. Challenges to the law are already ensuing. If allowed to stand, the act also creates a private right of action for any individual or entity who sustained an injury in fact, actual, or threatened from a municipal or county ordinance. Damages, however, are limited to declaratory and injunctive relief and costs and reasonable attorney's fees. Need more information on the content in this edition? HR Works is here to help. Current HR Works clients may contact the virtual helpline or their HR consultant for additional information on these legislative updates and next steps. Non-HR Works clients may contact us for HR solutions by calling toll-free at 1-877-219-1020 9062 or visiting our website. Before we close out this edition, we wanted to let you know that HR Works will also be hosting a free webinar on Wednesday, September 27th, entitled I'm Not Dead Yet. In this 1-hour program, we will provide an overview of the legal requirements related to age discrimination in the workplace and best practices for compliance and the benefits of maintaining an age-diverse workforce. SHRM and/or HRCI credit will be available for live attendees. We hope that you can join us. And with that, we would like to thank you for watching this edition of the HR Focus.